What happens to wealth when the world goes to war? Most people think it's random. Markets panic, you ride it out, and what happens, happens. But what if I told you that it wasn't random at all? That every war leaves behind a pattern that when examined closely shows that one asset throughout history has consistently protected wealth while everything else crumbles. You would want to know about it, so that's why today in this video we are breaking down with proof the stock market versus gold across three major wars: World War II, Vietnam, to the Iraq War, so that you can see the wealth shifts that most people miss, but smart money never does. Because the media, they don't tell you about this, but I want you to have all the information and tools so that you can make the best decision to protect your wealth before it's too late. Let's get into it. We're going to start with World War II, which was arguably the most destructive war of the 20th century. Again, we're going to start by looking at the stock market, then fiat currency and gold to see who was able to protect their wealth and how and who wasn't. So first things first, we're going to look at the Dow from about 1939 to 1941 here. So we have a historical chart we're going to look at. And first things first, this is actually interesting. This is something we see a lot over here on the left. Do you see this spike, this kind of jump up here? That's initial optimism preceding a war. This is something we see a lot where there's this sentiment. This was happening here on Wall Street, that there's going to be a lot of production happening around the war and therefore a lot of profit to be made. So you see this optimism happening, which is inevitably short-lived. As Germany invades Poland and things continue to plod on, you really see everything start to take a turn for the worse. Now, this continues to decline, and of course, with the bombing of Pearl Harbor, things just fall off a cliff, and over this 2.5-year period, the Dow lost about 1/4 or 25% of its total value. But gold was a different story. Now, you might be wondering, how are we going to look at the value of gold during the same time period? Which it is difficult to do because technically gold's price on paper was the same. It was fixed. It was pegged to the dollar, $35 an ounce. But what we can look at is gold's value against the declining fiat currency. So what I mean by that is, as inflation ran rampant and the value of the fiat currency continued to diminish, gold continued to rise against it. This is something that we see time and time and time again with failing currencies, and especially during times of war, two things that often go hand in hand. Now, over in Germany in particular, failing fiat currency, I mean, you see the images of people with wheelbarrows trying to buy a loaf of bread, whereas gold, an ounce of gold, well, that would buy you land, that would buy you shelter, could offer you protection, escape, could feed your family for a month. It's because people trusted gold. They trusted gold and silver because they knew that these were real tangible stores of value, unlike a currency which there was no promise would be worth tomorrow what it was today. I actually have a chart right here that shows gold relative to the fiat currency during this time period. Now, this is a longer time period, and I'll explain why we're going all the way to 1948. But you can see gold here, right? Here's 1939, boom, 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 straight up, straight up. It goes straight up. What would you rather be holding during this time? Gold or a failing paper promise? And the reason why I bring this all the way to 1948 is that we talk a lot about currency resets here at ITM. And I know this is a bit of a tangent, but go with me on this because it's this important. So currency resets, right, where they revalue or devalue the currency because they can, because it's not worth anything intrinsically. This happened in 1948. So we talk a lot about Weimar or Germany during World War II, but in 1948, I don't think enough people realize that the German mark actually became so worthless that they did an official currency revaluation. They rolled out the Deutschmark. And during this time, it was revalued 10-1, meaning if you had $100,000 in your bank account, that was slashed down to $10,000. But do not fear. Guess what they did to soften the blow? So June 20th, 1948, they introduced the Deutschmark. And as part of its launch, every resident was given startup money in the amount of 40 Deutschmarks. Oh, and to be fair, a second installment of 20 Deutschmarks was paid out later. Here's a photo. Here's a photo of a woman getting her 40 Deutschmark allotment. Doesn't matter how much you had in your account before. You could have been a millionaire. Doesn't matter. This is what you're getting. Every single person got the same amount. Now, this is wild because, again, this is really just insult to injury. But when people are so desperate, When the currency is worth nothing, then anything feels like something, and that is the situation people who held fiat currency were left with, whereas those who held gold and silver were able to not only protect their wealth, but actually thrive on the other side. So one of the lessons here is it doesn't actually matter what gold's official price is on paper. What matters is gold's value, right? Gold's price was technically the same throughout this period of time on paper, but its value was much higher. The currency lost 90% or more of its purchasing power on average. So imagine losing 90% of your savings, your retirement, everything you own. The stock market went down about 25%, but gold, its value soared. Those were the people who were protected. So let's go ahead now and fast forward a couple decades. The Vietnam War was a very different type of war with a very different type of economic fallout. If we look at the 1960s, the US was funneling tons of money into the war and huge government programs, creating a massive deficit and a growing inflation bubble. We're going to start again by looking at the Dow Jones, this time in 1965, which is when the first U.S. combat soldiers touched down in Vietnam. Now, we kind of see this initial, again, the same thing here. Let me go down. This initial optimism. Who knows what's going to happen? Maybe this is going to be good for profits. And then quickly, those dreams are dashed. And this one's an interesting one over the 10 years because we see a really classic kind of stock market cycle here going back and forth. And really by the end, though, of the 10 years, you can see that we are down. I think it went down roughly 30% over a 10-year period. So not great for anyone that was holding out during this time. But the same way we looked at a slightly longer timeline when we were looking at World War II, I think the same would be fair here. So if we open this up a little bit, it's interesting because someone might say too, you picked the worst part to end. Now, technically that was the end of the war, but let's just open it up here. So we've got this going to what, 1980, give it a couple more years, maybe 1982. Now, if we look at the start here from 1965 to 1982, I mean, we basically, again, did a round trip over 15 years to nowhere, right? We started where we ended where we started. But this does not tell us the full picture because what was the stock market valued in? It was valued in USD. Now, what happened to USD during this time period? Its value went straight down. So if we look here at the consumer price index, so this is a measure, right, of the purchasing power of your dollar, we have right here, 1965, okay? What happens over here? 1982, boom, we go from 319 down to 105.9. That is roughly two-thirds of a loss of your purchasing power over what, a 15-year period of time? That is brutal. So if we go back and we look at that stock market chart that we were just looking at here, it might look, again, like a round trip to nowhere, that we just broke even, that nothing happened. But in reality, if we compare that against what was happening to the dollar, everyone who just held on to their stocks for that period of time lost nearly 70%. 70% of their value. It might have been the same in nominal terms, but in real terms, they lost money. Also, a quick side note, I try and be really intentional with my words. If you've been watching for a while, you probably noticed this. Money is gold. Gold is money. The dollar is a currency. The reason why is because it is not a true store of value, something that we are going to continue to see time and time again. But I said money there because I think emotionally it strikes a chord. When you think about losing 70% of your money, of your savings, even if it's your paper savings, I mean, that is just brutal. But what happened to gold during this period of time? Now, again, this is an interesting period in history because this is accounting for when President Nixon took us off the gold standard completely. He delinked the dollar from gold. And of course, this was the first time that we saw gold actually move freely in terms of price. All right, so let's look at gold now on this chart. So we have gold prices, 100-year historical chart, and we are going to see again here, this is when President Nixon delinks the, did you guys see that BlackRock ad? Anyway, it drives me nuts. In case you missed it, let me just see. BlackRock, make bond laddering easy with iBond ETFs. Give me a break. Know your audience. Anyway, sorry. Okay, so down here, 1971, President Nixon delinks the dollar from gold, and we see gold what? Obviously, it takes off because it's a safe haven asset. In fact, if you owned and held gold from 1971 to 1981, that would be worth almost 2,300% more. So 2,300% higher. That's what that value of that gold would have done, while everyone in the stock market was losing 70% of their purchasing power. Imagine if you put $100,000 in the stock market in 1971, it would nominally be worth the exact same amount 10 years later. But again, because of that decline in your purchasing power, right? Again, if we go over here, that decline in your purchasing power, it would be worth $30,000 in real terms. But if you had bought gold in 1971 at $35 an ounce and held onto it for 10 years and it jumps up, I think this is a month average, but at its peak, it was over $800 an ounce. I mean, that's what, $2.4 million? Which one would you rather have? But let's fast forward again, this time to the early 2000s, to the Iraq War, which was technically 2003 to 2011. Now, I know someone out there is going to say, well, wait a second. During that time period, didn't the great financial crisis happen? How can we compare the two or separate the two? Wasn't 2008 a housing bubble and derivative crisis? And you would be correct. It was. That was the spark that lit the great financial crisis. But what we're looking for here is a bigger pattern, and it wouldn't be correct to not include an example of a modern, open-ended war, one where we saw extreme printing and fragility that contributed later on to a crisis, right? Defense spending more than doubled during this time period. Everything was built on debt. Often it was outlays that weren't accounted for in traditional budget. On top of that, easy credit was something that we saw during this time period. All different factors that helped contribute to what ultimately happened in 2008. Let's start with the S&P 500. So we have this chart here. We're going to look at 2003 to 2011. So if we start here at 2003, we're working with roughly 900 points. Over the next 4 years, however, there was significant growth, right? I mean, we jumped up to what, 1,600 here, 1,400, depending, at the end of 2007. So, I mean, that's not too bad right there for a day's work. But of course, I don't have to tell you what happened in 2008 because the system was built again on cheap credit, on high risk, high leverage. So when everything came crashing down, it came crashing down bad. You know, during that time period, people were calling their 401ks 201ks because they had been chopped in half. That's what happened to everyday Americans. And by the time the war was over in 2011, you know, I mean, things had gotten better, but not significantly better. And people were still down from where they were in 2007. And a lot of people were counting on that, of course, for their retirement, for their financial future. But gold, let's look at gold again during this gold. I'm so sorry, you guys. Look at this ad again. BlackRock, get out of here. Okay, if we look at gold during this time period, so we have 2003 again to 2011. In 2003, gold was sitting at around $350 an ounce. You know, by 2008, by 2009, what had happened here is gold had more than doubled to over $900 an ounce. But this is the difference maker. Already, this is going to be better than what was happening in the stock market. But then gold continues to go up. We continue to see it go up. If we go back over here to what we were looking at, we started in 2003, 920, 950, something around there. Where did we end in 2011 after we recovered? 1,100, maybe 1,000, 1,100. That's not that big of a jump when we're looking at what happened to gold. This is, of course, because the government continued to print tremendous amounts in response to the great financial crisis. And as the dollar continued to be devalued, we continued to see gold as a true safe haven asset rise to its proper place. I mean, just looking at this over the same time period, gold went up 400%, but it's not even about how much it went up or how it performed. That's not the point here. The point is that over history, when we look at all of these patterns, there is a clear pattern that emerges that shows that gold does not need the system to be functioning in order to do its job, right? When the system is breaking, gold is still going to protect your purchasing power and provide you an escape from the system that is failing, whereas all of these other assets are going to crumble along with the system, right? They were not designed to operate outside of the system. They were not designed to withstand and weather the storm the way gold was. It feels uncertain right now because it is. Times are very uncertain, but that is even more reason to make sure that you're protected, that you've got a plan, a strategy, that we're not just looking the other way and hoping that things end up okay, because hope is not a strategy, right? Don't wait, trust your gut. That's what I always say, trust your gut. That uncertainty is the exact reason why people should be taking action now. And it's why we have a free gold and silver guide. If you don't already have your copy, download it. It's an incredible first resource for those who are getting started or even those who have been here for a while and want more information on gold and silver and how it can protect your wealth. You can download it by clicking the link in the description. You can scan the QR code, whatever works. And of course, we have an expert team of analysts. They are here to help you answer your questions, protect your wealth, just like they have for so many other people. All you need to do is call us at the number below or click the link in the description to set up a time that works best for you. This is what our team does day in, day out, is help people create a custom strategy, one that will protect you again from what's coming next. So do not wait. It's too important to put off. And in the meantime, as always, I so appreciate you being here. I'm Taylor Kenny with ITM Trading, your trusted source for all things gold, silver, and lifelong wealth protection. Until next time.